A 50-year-old engineer is going to make $1 million on his W-2 this year, calls me up and says, hey, I'm about to get hosed in taxes. Do you have any strategies for me? I said, yes, I have 3 needle-moving strategies for you. But first, let's make sure that you're taking advantage of all the low-hanging fruit. We confirmed he was already maxing out his pre-tax 401k and his HSA. He was doing a backdoor Roth and a mega backdoor Roth. So I said, all right, here's the 3 strategies I got for you. Number 1, short-term rental. Number 2, invest in a working interest in oil and gas. And number 3, start and fund your own charity. Let's break each one of those down, starting with the short-term rental. So the idea with the short-term rental is that you buy a piece of property and you have an average period of customer use of 7 days or less. That means people are not staying there for a month, 2, 3, 4 months. No. When we look at all of your stays for the year, and we look at the total number of days it was booked, the average period of customer use has to be 7 days or less for you to qualify for this strategy. So that's part number 1. Part number 2 is you have to meet one of essentially 3 different material participation tests. Yes, there's 7 tests in all, but 3 are the ones that really apply here. So number 1 is you need to be able to say that you did substantially all of the work. So the minute you've got maintenance men, cleaners, managers in there helping you out a lot, you're going to blow that test, right? You need to be able to say, I did substantially all. Could you get a plumber in there once or twice? Yeah, maybe. Number 2, you did 100 hours and more than anybody else. It has to be both. You got to get in 100 hours and you got to be able to say you did more than anybody else. So can you have cleaners? Can you have maintenance men in there? Can you have some help? Absolutely. But you're going to want to keep track of the hours that they worked, because under audit, the IRS is going to say, okay, well, if that's the material participation test that you claim to have met, show us your log of hours and what you did specifically managing and operating this, and show us the log of hours that other people did, because nobody can have worked more than you. And moving on to number 3, essentially the gold standard. If you're able to say that you did 500 hours or more, then you don't have to keep track of anybody else's hours, but it's going to be really hard to get to 500 hours with just one rental. You learning and educating yourself about rental properties and studying the financials of the rentals does not count. All right, so that's the short-term rental strategy. You need material participation, average period of customer use 7 days or less. And now, if you've achieved these, any loss from this short-term rental can be used to offset your W-2. How do we ensure there's a loss? You get a cost segregation study done. What a cost segregation study does is a team of engineer accountants looks at your apartment and says, all right, well, this house is actually comprised of various different components with different useful lives. A driveway has a different useful life than your electric, than your plumbing, than your roof, than your flooring, than the bushes and the shrubs, right? Without this cost segregation study, you need to depreciate this over 39 years. With the cost segregation study, you're going to be able to accelerate depreciation on roughly 25 to 30% of the depreciable base of the property. So let's just say you bought a condo for $1 million. There's no land value because it's a condo. Your depreciable base is $1 million. After the cost seg study is done, we know that roughly 25% of that $1 million value will be comprised of assets with a useful life of 20 years or less. The reason 20 years or less is important is because you can only apply bonus depreciation to an asset with a useful life of 20 years or less. So what this means is that on our $1 million property, we did a cost seg. We're going to have $250,000 of loss that can be used to offset our W-2 income. That's big. Moving on to strategy number 2, investing in a working interest in oil and gas will generate a loss that can be used to offset your W-2 income. Not many investments like this. Typically, if you want to use a loss from a business to offset your other income, you got to meet one of those material participation tests, not with a working interest in oil and gas. Let's get specific. You invest $100,000. that first year, you're going to have a loss of roughly 60 to 80% of the amount that you invested. So let's just call that $70,000, right? So that $70,000 can be used to pay less tax on your W-2 income. If you're in a high income tax state, California, where you're paying 13% plus and 37%, you're in the top federal tax bracket, you're paying 50% in taxes. So you put in $100,000, you get a $70,000 loss, $35,000 is how much you're saving in taxes, right? Because with a $70,000 loss, you are in the 50% bracket, so you're saving half of that. Moving on to strategy number 3 is starting your own charity. So picture this. You got $100,000 that you want to invest in a charity, and let's just say for the purposes of this example, you're in the 40% tax bracket. So you put $100,000 into a charity and you're going to save $40,000, right? Because you've got $100,000 less of taxable income. Every $100,000 of taxable income that you have, you'd pay an extra $40,000 in taxes. So since we shaved $100K of taxable income off your tax return, you're saving $40,000, right? So you're like, oh, great, Arash, I saved $40,000 and I, helped out the Red Cross, but I'm still out $60K. How does this benefit me financially? Well, that's where starting your own charity comes in. So let's say you contribute that same $100K to a charity that you founded, you get the same $40K tax savings, but now you get to control what happens to the $100K because you're on the board of that charity. So this means that you can cut yourself, your spouse, family, friends, anybody who wants to show up and do work for the charity can receive a paycheck. So you can put your kids to work on the charity, right? You've saved the taxes and now we've got a job for our kids or whoever. That a lot more to unpack there, but that's the general idea of that strategy. Now, the engineer was very excited about these 3 different strategies. He was gung-ho to start them all. And I said, well, you got a lot to do. You got to buy a house, manage it, rent it. You got to do a lot of due diligence on an oil and gas investment because there's plenty of shady characters there. And you got to start a charity. That could take months, could take years, who knows? And you got to work at the charity. Nevertheless, he had a plan, and that's why it's important to create a tax plan.